Welcome back to the deep dive. Today we are wading into some territory in finance that, frankly, scares a lot of people off.
Oh, yeah.
If you've ever tried to look up risk-neutral measure, you've probably hit a wall of language that is so dense.
Absolutely impenetrable.
Things like measure theoretic transformation or the probability measure of a transformed random variable. It feels like it's designed to be confusing.
It really does. It's the kind of jargon that turns a really beautiful and fundamental piece of math into something that feels like it's only for the quants.
Right.
But the core idea here is, I think, deceptively simple. And it's absolutely central to how all of modern finance works.
Okay, so let's unpack that. Our mission for this deep dive is to just cut right through all of that jargon. We're going to frame the risk-neutral probability, or RNP, as the market's ultimate janitor.
The ultimate market janitor. I like that.
It's the essential tool that financial markets use to enforce fairness, to enforce consistency, and to eliminate any chance of risk-free profit, arbitrage.
And the really profound idea behind it is this. It's a theoretical, an imaginary framework that we use for pricing.
Okay, an imaginary world.
Exactly. And in this world, we assume that all assets,
Even really volatile things like stocks.
even highly volatile stocks,
Yes.
we assume they all grow at the exact same rate,
Which is?
the risk-free rate. And that simple assumption lets us discount all future cash flows back to today using that single, clean, risk-free rate.
So we're just sidestepping the whole messy business of trying to guess how risk-averse every single investor is.
Precisely.
To see how this mathematical alchemy actually works, we're going to use the simplest possible environment we can think of, a one-period binomial model.
Okay, let's set the stage. This is the sandbox we'll be playing in for you. Imagine a stock. Its current price, we'll call it S0, is 70 pounds.
70 pounds, got it.
And we're looking just 1 year into the future. And we're going to assume only two things can happen.
Outcome one. The stock goes up, the price hits 84 pounds. That's a 20% increase, so we'll define the gross return, R sub U, as 1.2.
And outcome two,
The stock goes down, price falls to 56 pounds.
a 20% decrease.
Yep, so the gross return there, R sub D, is 0.8.
And crucially, we need one more piece of the puzzle. The risk-free rate, R, we'll set that at 5%.
Right, 5%.
Which means the gross risk-free return, 1 plus R, is 1.05.
Yeah.
These are the only numbers the market structure gives us.
Now let's talk about the real world for a second, because this is where all the chaos starts.
Right.
If you ask a real world investor, let's call him Grandpa, who's very risk averse,
Yeah.
he might say the chances are, I don't know, 50-50, or maybe 1/3 up, 2/3 down.
Sure, his personal subjective belief.
Exactly. And those real world probabilities, they reflect his personal outlook. He'd demand a higher expected return, maybe 10 or 15%, just to hold that risky stock.
And that's the problem. If he used his 15% rate to value a derivative, he'd get one price. But if Grandma, who's totally risk neutral, used a 7% rate, she'd get a completely different price.
That subjectivity makes it impossible to price things. So how do we find the single objective fair price for something like a simple European call option on that stock with a strike price of 70 pounds?
Okay, first things first, we nail down the option's payoffs at expiration. No subjectivity there.
Right.
If the stock goes up to 84 pounds, the option is worth 84 minus the 70-pound strike. So the payoff, C sub U, is 14 pounds.
And if it goes down to 56?
Then it's below the strike price, so it expires worthless. The payoff, C sub D, is 0.
So we know the future outcomes, 14 pounds or 0. The real problem is, what discount rate do we use?
And this is where the huge insight from Black-Scholes and Merton comes in.
Yeah.
We don't need to guess the discount rate if we can replicate the option. The price of any derivative has to be based on our ability to build a replicating portfolio.
Explain that. What is a replicating portfolio? Why is it so powerful?
Think of it like building a synthetic option, a perfect financial clone.
Okay.
This portfolio only has two assets in it, the underlying stock and the risk-free asset, like a bond. The whole goal is to figure out the exact fraction of stock to buy and the exact amount of money to borrow or lend.
At the risk-free rate?
At the risk-free rate, yes, such that the combined payoff of that little portfolio perfectly matches the option's payoffs. 14 pounds or 0 in both the up and the down states.
So you're building a mathematical clone of the auction, and the cost to build that clone is, it's an objective, verifiable number. It's not like Grandpa's opinion.
Precisely. And because the cost of that clone is totally independent of anyone's personal feelings about risk, if the real option in the market trades for anything else,
Arbitrage.
an arbitrage opportunity instantly exists. And that's how the market enforces fairness.
It's kind of magical. You're saying this mathematical clone is so powerful it just removes human bias from the price?
Yes, do.
If the options market price is exactly what it costs to build our little synthetic portfolio, there's no way to make a riskless profit. That single price is the arbitrage-free truth.
That is the very definition of a fair price. And this whole risk-neutral probability framework is just the mathematical tool that formalizes this no arbitrage condition.
Which brings us to section 2. Let's actually solve for the market janitor's magic number. We're going to find that specific theoretical probability pi that makes a whole market arbitrage-proof.
And just remember the goal of pi. It's the probability weight that. It forces the expected return on the stock to be exactly equal to the risk-free rate.
To the 5%.
To the 5%
Right.
or 1.05 gross. By forcing the risky asset's expected return down to the risk-free level, we've mathematically neutralized its risk.
And that's what lets us use the risk-free rate to discount everything.
That's the key.
What's so elegant about this is that pi, this theoretical probability, it only relies on the parameters we already have. The risk-free rate, the up return, the down return, it's all derived from a market structure.
Yep. So let's walk through the formula. If you're taking notes, this is the time. We're solving for pi, the risk-neutral probability of that up move.
And we're using gross returns for everything.
Always gross returns.
Okay, the formula for pi is the numerator on top is the gross risk-free return 1 plus r minus the gross down return r sub d.
You can think of that numerator as the extra premium you need to get from the risk-free rate up over that worst-case down move.
And the denominator, the bottom part, is the gross up return r sub u minus the gross down return r sub d.
Which is just the total spread of possibilities, the total range of outcomes.
Okay, let's plug in the numbers from our 70-pound stock examples. We have gross risk-free return 1 plus r is 1.05.
Right.
Gross up return r sub u is 1.2.
1.2.
And gross down return r sub d is 0.8.
Got him.
So starting with the numerator on top, we have 1.05 minus 0.8. That gives
0.25.
0.25. Okay, now the denominator. We take the total spread, 1.2 minus 0.8. That gives us
0.4.
0.4.
Now for the final step, just divide the two.
We divide 0.25 by 0.4, and the result, the risk-neutral probability of an up move, pi, is 0.625.
Or 62.5%.
Which means the probability of a down move, 1 minus pi, must be
0.375.
37.5%.
There you go.
So in this weird, theoretical, arbitrage-free universe, the mathematical odds of the stock going up are 62.5%.
Right, which is probably higher than most people's 50-50 guess.
Yeah, but you said this isn't a forecast, it's a weight.
Exactly. I can't stress that enough. That 0.625 is purely a mathematical construct. It's the specific weight you need to perfectly balance the market's internal structure so that arbitrage becomes impossible. It has nothing to do with whether you think the company will actually do well.
So it's the probability that has to exist in this little model world.
To guarantee the stock's expected return is exactly the risk-free rate. Yes.
Okay, now let's use it. Let's use this RNP to find that fair option price.
We take the RNP, we use it to find the expected payoff of the option in the future, and then, this is the crucial bit, we discount that whole expectation back to today using the risk-free rate.
So the formula for the fair price, C0, is the risk-neutral expected value of the future payoffs, all divided by 1 plus r.
Yep. Let's calculate that expected payoff first. It's pi times the up payoff of 14 pounds.
Plus 1 minus pi times the down payoff of 0.
Right.
So that's 0.625 times 14 pounds plus 0.375 times 0.
Which comes out to an expected option payoff of 8 pounds and 75 pence.
Okay, 875.
And finally, we just take that future value and discount it back to today. We divide it by our 1.05.
And the result, C0, the fair price of our call option, is approximately 8 pounds and 33 pence.
And that number, that 8 pounds 33, that is the only price where no one can package up the stock, the bond, and the option to make a riskless profit.
Arbitrage annihilation.
Complete.
Okay, complete. You mentioned this idea, the martingale property. You said that's what this process enforces. What does martingale actually mean for our listener?
The martingale property, it's just a formal way of saying it's a fair game.
A fair game.
It means that if we look at the stock price after we've discounted it using the risk-free rate, its expected movement from that point is zero. There's no upward or downward drift baked in.
So if you buy it for £70 today, you expect its discounted value to still be £70 tomorrow.
Exactly. You'll earn the risk-free rate on your money just for holding it, but you don't expect any extra gain from the volatility, not once we've neutralized the risk.
That makes a lot of sense. So once we account for the time value of money, the only thing left is random noise. No predictable risk-free profit.
And that whole framework has huge practical utility. I mean, why should you, the listener, care about this very specific hypothetical probability?
Yeah. Utility number one seems to be ignoring risk aversion. That price we found, $8.33, it's objective.
It is.
It doesn't matter if grandpa is terrified of risk or grandma loves it. The arbitrage-free price is the same for everyone because it's built from the market structure, not from feelings.
Utility number two, market stability. Arbitrage-free pricing prevents what you called infinite money pumps.
Right.
If the fair price is $8.33 but the option is trading at £9, arbitrageurs will jump on that instantly, sell it, replicate it cheaper, and their actions force the price back down. It enforces consistency.
And number three, and this is probably the biggest one for traders and banks, is effective hedging.
Absolutely. Since the RNP is fundamentally tied to building that replicating portfolio, it gives you the exact recipe for a perfect hedge.
So when a bank sells an option,
they immediately use this math to figure out the precise fraction of the underlying stock they need to buy or sell to completely offset the risk of that option they just sold.
And that fraction changes all the time, right? As the stock price moves.
It's changing constantly. You have to continuously rebalance that replicating portfolio to maintain the hedge. We call that delta hedging in the more complex models.
And that continuous rebalancing,
right.
That's the conceptual leap from our simple one-step model to the big one, right? The Black-Scholes model.
That's the connection.
Yeah.
Black-Scholes is just this idea, but applied in a world where the stock price is moving up and down an infinite number of times, and you're rebalancing your hedge continuously. But the core assumption, neutralize risk, discount at the risk-free rate, it's exactly the same.
Okay, let's do that robustness check then. I really want to challenge this and see if it holds up.
Yeah.
To understand its role as a janitor, not a forecaster, we found the RNP for the up move, pi, was 0.625. But let's say we had some incredible, rock-solid, real-world research. And it showed us that the actual objective probability of the stock going up wasn't 50-50, it was 80%. A massive 80% chance of an up move.
That's a huge shift in the real-world view.
It is. So if the real world says there's an 80% chance of a payoff, but your model uses 62.5% to get a price of $8.33, isn't the model just wrong? Shouldn't the option price go up?
That is the absolute core paradox that RMP solves.
Yeah.
And the answer is no. The option price does not change. The risk-neutral probability, pi, remains 0.625.
But why? That feels so counterintuitive.
Because the pi value comes only from the market's structural constraints.
The risk-free rate and the up and down moves.
The risk-free rate, the maximum up move, and the maximum down move. That's it. It's a function of the market's architecture, not your personal forecast. The second that the stock, bond, and option prices stop satisfying that pi equals 0.625 condition.
Arbitrage appears.
An opportunity for riskless profit appears, and traders will exploit it instantly, forcing the price right back to £8.33.
So the options price is defined by the fact that you can build the replicating portfolio. And your ability to do that has nothing to do with how likely the stock is to actually go up.
That's the critical distinction to grasp. RMP is a mathematical bridge that enforces consistency and simplifies valuation. Real-world probability is what you need for forecasting actual outcomes, but RNP is the key to pricing that consistency.
This really has been a deep dive. The key takeaway here seems to be that risk-neutral probability. It isn't a probability for predicting the future. It's a fundamental theoretical weight, and its only job is to enforce the no arbitrage condition.
And that is the bedrock of all modern derivatives valuation.
And on that note,
I'll leave you with a final provocative thought based on that exact math. For pi to be a valid probability, it has to be between 0 and 1, right? But we know that pi is derived only from market variables. Now, what if the market implies too much volatility? Meaning, the up and down moves are so extreme relative to the risk-free rate that the formula mathematically spits out a probability that's, say, greater than 1 or even negative. If the RMP, calculated from market prices, ever came out to be 1.1, what specific immediate action could arbitrageurs take to profit from that inconsistency and restore order?
Something to mull over. For listeners who want to keep that core R&P formula handy, we've put a downloadable cheat sheet link with the formula right there in the description. Thank you for joining us for this deep dive into arbitrage annihilation.
We hope you walk away feeling a little bit wiser and a lot more comfortable with the market's ultimate janitor.